What's up, guys? Welcome back to the channel. So this video is going to be all about stocks and shares ISA because we are about 20 days out from the start of the new tax year. And what that essentially means is that our ISA allowances are going to reset. We're going to have another £20,000 that we can invest come April the 6th. So what I want to do here is speak about stocks and shares ISAs, make sure that you're in the best position possible to fill your boots for the current tax year, but also make sure that you're best positioned to take advantage of your allowances for the new tax year on April the 6th. We're going to be talking about how you go about selecting providers because there's lots of them out there. And I'm going to give you maybe some comparisons, some things to consider so that you can hopefully put yourself into a bucket to know, right, if I fall within this bucket, then these group of providers are going to be best for me. So lots to cover. Let's get going. All right, guys, so look, I'm not going to cover a lot of the basics around ISAs. I've done quite a few videos specifically on that, so you can go and watch this video right here. I'm not necessarily going to touch on the ISA rules either. What I want to do with this video, though, is just try and maybe touch on what a stocks and shares ISA is, just in case you're watching this, you don't really know what it is first and foremost. And then we're going to get into provider selection and essentially what kind of investor would basically match the kind of provider you are, because this is a really, really important thing, guys. And one of the most common questions that I get is, you know, Pete, should I use Moneybox? Should I use Wealthify? Should I use Trading 212? The answer to that isn't a simple go and use Moneybox, because it's all about what you need based on your circumstances. So I want to try and give as much nuance as I possibly can with this, but that's what we're going to cover. So let's talk about what a stocks and shares ISA is. A stocks and shares ISA is essentially an investment ISA. So it's invested in the stock market, and it could be invested in the S&P 500. It could be invested in Tesla stock. It could be invested in Amazon stock. It could be invested in Roblox. It could be invested in anything that you essentially want, but it's invested in the stock market. And because it is invested in the stock market, it's very, very important to bear in mind that your capital is at risk. The market is volatile. So you have to be the right kind of person approaching this with the right kind of mindset as well. You need to understand what risk you're willing to take and what risk you're able to take as well. Two distinctions, but very, 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 very important to bear in mind. Now, when you look at the kind of ISAs that are available, you've got stocks and shares ISAs, but you can also have junior ISAs, which are stocks and shares ISAs. You can have a lifetime ISA that is also a stocks and shares ISA as well. This is really important to acknowledge because everything that we'll talk about will be transferable to your lifetime ISA and your junior ISAs as well. Even your help to buy ISAs if you do have one of those old help to buy ISAs that you can no longer open. Now we have to talk about the tax year because the tax year is important. Those set of dates are crucial for you to understand if you're investing. And if you follow me for a long time, you will know that one of my catchphrases is tax efficiency first, meaning if you're investing, you really should begin investing in your ISAs first and foremost. Why? Because it is free from capital gains tax, it is free from income tax, and it's also free from dividend tax as well. So if you don't want to be giving unnecessary money away to the tax man, who probably already takes enough from you anyway, then you need to be starting with your ISAs first and foremost. It's the building block to everything. Tax efficiency first. So the tax year in the UK runs between April the 6th and April the 5th every single year. And during that period of time, the government allows us to save £20,000 into our ISAs, so into a stocks and shares ISA. Now, this is really, really important in the context of where we are right now. So we are 20 days out from our allowances resetting, which essentially means that up until the 5th of April this year, you can still save up to £20,000 into a stocks and shares ISA. The same applies for a cash ISA, but again, remember guys, we're talking about stocks and shares ISAs specifically for this video. So you can save £20,000 into a stocks and shares ISA between now and April the 5th. And what that essentially means is that if you've only used, I don't know, say £5,000 of your ISA allowance right now, you have £15,000 left over to use. Now, if you're a married couple, you can double that number by 2, which will give you £30,000, assuming the both of you have used £5,000 each of your allowances. The next date that you have to know is the beginning of the new tax year, which is essentially April the 6th. And that means, again, that you can invest £20,000 into an ISA. If you're a couple, married, then your wife or your partner, your husband, will have the same as well. So for many of you who may be quite lucky to be cash rich, it essentially means that assuming you've not used any of your allowances, you can save up to £40,000 if you're an individual and £80,000 if you are a couple, right? I'm just going to repeat that just so that it's clear. So assuming you've not used any of your £20,000 allowance this current tax year and you have enough cash lying around, you can save £20,000 into an ISA before April the 6th this year, so by April the 5th this year, and come April the 6th, you could also save another £20,000. So as an individual, £40,000, as a couple, £80,000 across the remainder of this tax year and the new tax year moving forward. So let's talk about providers, because providers are really important. If you are going to invest, you're going to be using somebody, right? So there are different kinds of providers, and the different kinds of providers will depend on where you are in your investment journey, i.e., are you the kind of person that, number one, doesn't have the time to research stocks, doesn't really understand how everything works, but you want to invest and you'd rather just give the money to someone to manage? That would put you in the group of maybe robo services, right? So that would be the first category that we'll talk about, robo services. If you're the kind of person who, contrary to the person who just wants to kind of give the money to someone and just let them invest it, wants to be in more control, but wants to focus specifically on investing in individual companies, so picking stocks, picking maybe a limited number or a wide range of ETFs and funds, then there's going to be a category for you, which is what I'm going to call the DIY category, right? And then we've got the last one, which will be kind of like the hybrid, the ones that will give you access to index funds, ETFs, and maybe give you the ability to also buy individual stocks as well. So that will be the hybrid category. So 3 categories altogether, and I'm going to go through when you might decide to use each of them. So what investor profile do you need to have to match one of the robo services, for example? What profile do you need to have if you're going to be a DIYer, for example? And what if you're a hybrid? What does your profile look like? So we're going to talk a little bit about that. And as always, I'm going to give you a bit of comparisons around key things to consider in each of those categories. So let's talk about robo services, or the robo category, first and foremost. Okay, so in the robo category, you're going to have a number of providers that you guys will already know. So I'm talking about the likes of Wealthify, Moneybox, Nutmeg, Plum, Money Farm will be in there as well, and maybe a host of other ones as well. And these are essentially services where you sign up to them, they already have a pre-made investment portfolio built for you, and they'll probably take you through a little bit of a risk questionnaire to determine what kind of fund you're going to go into. And essentially, once it's set up, you do a direct debit or a standing order straight over to them, and they invest it on your behalf. It takes away a lot of the worry of having to research stocks or read about index funds or ETFs yourself. And it could spit you if you are really, really busy. So if you've run in a business, you've got a busy career, you want to focus on family, you don't really have that much of an interest learning about these things specifically. And look, let me just say this straight off the bat, guys. Not wanting to learn about investing in index funds and ETFs is completely fine. I mean, look, a little knowledge can also be very, very dangerous. And I've had someone who's contacted me over the last couple of days with exactly the same thing, you know, thinking that I want to take control of my own investing, but there's a whole host of things that you may be missing. Watching 1 or 2 YouTube videos doesn't necessarily make you a professional being able to pick your own stocks or pick your own index funds or ETFs. So there's a lot of information that goes into this. If you are the kind of person that doesn't want to be dealing with it, robo services, this robo category will be great for you. Now, there are a couple of things that you need to bear in mind when you look at the robo category, right? And that is the fact that these companies have set up portfolios on your behalf. So they will go through a process with you to make sure that you understand what your risk profile is, and then they'll put you into a portfolio of their making, of their choosing. And in doing so, essentially means that they are taking away all of that from you. And with that, there are going to be fees. The fees that you're going to be paying broadly are in the region of about 0.45, maybe up to 1%, maybe a little bit more. And that will include annual management charges from the provider itself. So for example, Wealthify, Plum, Moneybox, they'll have their own annual management charge. And then you're probably going to have a fund manager charge on top of that, possibly some further spreads in there as well. Now, the argument is that these guys are really, really expensive. And look, I beg to differ because it really depends on where you are. And this is my saying that I used to use when I was in Canary Wharf quite a lot, and certainly when I was advising clients. Cost is only an issue in the absence of value. You need to think about what they're doing in exchange for the 0.45% or 0.6% that you pay them. And if for you, you're a first-time investor, you don't have the time, you don't want to learn, you're just too busy to focus on, even thinking about reviewing this on a yearly basis because you just don't have the time to do it, you just don't want to do it, then 0.45, 0.6 may be worth your while because you see value in the fact that they're saving you time. That isn't for me to kind of judge or lay on you. That is your decision to essentially make in selecting your provider. But I think it's very, very important to bear in mind. Many people will start this process looking at cost, and cost is an issue, but it's not the only issue that you should be considering. So with these guys, they are going to be a little bit more expensive than some of the other options that we're going to talk about, but that is to be expected because they are basically taking this entire thing off your plate and they are managing it for you. They will review it for you and provide additional services as well. If you are going to select one of these guys, I would strongly recommend that you do a comparison. So in addition to the cost comparison, you should also try and see if you can see what their past performance is. And yes, past performance is no indication of future performance, but past performance will give you an idea of whether they've actually read the markets well, say in 2007, 2008, or more recently in 2017, 2018, okay? So really, really important for you to bear that in mind. Do a comparison on that and also compare what level of service they're actually offering you. A prime example of this is Money Farm, right? Money Farm actually have a team of people that you could pick up the phone to and actually ask questions and get guidance from. They do reviews for you. So they have an actively managed strategy that means that if the markets are actually falling and something doesn't quite match your risk rating, they will change that automatically for you. I would seriously have a look at what they're doing for the money that they're charging you. For people like Money Farm, you may think, oh, this is really fantastic. Wealthify don't offer me that. And I'm not saying that they don't because I don't know what level of service they offer. But looking at the detail of what they're going to offer you could be your deciding factor in terms of whether you decide to use them or somebody else. So 3 things definitely for you to consider there: cost, performance, and what you're getting for the service. That takes us on to the second category, which is the DIY category. So this DIY category is essentially if you want to be in complete control. So you may want to invest in Tesla, you might want to pick your own stocks, you might want to invest in Desktop Metals. That's one that we were discussing in our private members group on Sunday evening, doing some analysis on that stock right there. You may be the kind of person that wants to be able to spot opportunities on the markets and actually do this stuff on your own. Now for that, there's pretty much only 2 providers that kind of stick out in the market right now, and they are Trading 212 and Freetrade. So with Trading 212 currently, as of recording this video, they are not opening accounts right now, and today is the 15th of March. They've been on hold for about, it feels like 6 weeks now. It's crazy, ever since the GameStop AMC saga. They're not opening accounts right now, but they are pretty much the forerunners in this. And the reason why I say that is because you just need to have a look at their charging structure. So they don't have any administration charges. They don't charge any commissions on trades, and they don't charge you to reinvest the dividends as well that you might get if you do go and buy a dividend-paying stock. So they are front runners when it comes to keeping cost absolutely down. You're going to have some spreads, obviously, when you're buying stocks, and you're going to have to pay stamp duty and all this kind of stuff as well. Those are some of the costs that you will have built in to how you invest when you're using them. But they are, for me, front runners in that. The alternative to them, because they're not opening accounts right now, will be free trade. So free trade is very, very similar to trading 212. They give you access to the US stock market, the UK stock market. They also give you access to ETFs and other asset classes as well. Unfortunately, with free trade though, they do charge you a £3 a month fee to access the ISA account. Not a lot. If you look at this screen grab right here, you can compare them to other providers out there at the moment. And look, they are probably one of the cheapest when you look at this graph specifically right here. Hargreaves Lansdown, $11.95. And then with Hargreaves Lansdown, we will talk about in a moment, you're going to be paying 0.45% as well. You can see the charges there for Interactive Investor and AJ Bell. You can also buy fractional shares with free trade and trading 212 for that matter. So if you're trying to get into some of these big companies with small amounts of money, they'll be perfect for you in that regard. But with these guys, your profile has to be that you are somewhat savvy in terms of being able to understand how the stock market works, how these businesses work. You're probably going to be the kind of person who is hungry and wants to learn about how you analyze stocks, how you read financial accounts, all of that good stuff so you can make sound decisions of your own, how you pick ETF funds or how you pick index funds, right? You need to be willing to learn this kind of stuff. And I will just say that, we do try and make this thing as simple as possible. And at the core of it, the underlying theory isn't that complicated. But it isn't for everybody. It can be very, very time consuming. And oftentimes you have to have the confidence to know that I'm doing the right thing here. And if you don't know what you're looking at, it's very, very hard to do that. And with this, you have to acknowledge the level of risk that you're taking. Putting £20,000 or £20,000 or whatever it is that you invest into your stocks and shares ISA into a small number of companies is really, really high risk. And you have to be willing to accept that if, like 2 weeks ago, the markets are to take a hammering and the tech sector, for example, were to suffer again, then you've got most of your money in one place and you're not really diversified. And again, when we talk about investing, it's all about stacking the odds in your favor. Diversification is absolutely key. So you have to be the kind of investor that's, number one, willing to learn first and foremost, has to be happy with taking an extra level of risk on board, because the onus is on you to make these decisions. You have to make sure that you're picking the best stocks for you. And you have to be ready to accept the volatility that comes along with that as well. But in the DIY category, the two front runners, free trade and trading 212, are definitely the ones to use. There are links in my description which you can use down there as well. If you use free trade, you will get a free share. I will also get one. And when Trading 212 are back opening accounts, if they do come back to open an account, you'll also get a free share, and I will get a free share also with them as well. And this leads us on to kind of like the last category, which is the hybrid category. And in this category, we're going to have the likes of Hargreaves Lansdown, Vanguard, and we're also going to have in there, for good measure, Fidelity. Now, these guys will allow you to kind of have control over how you invest, i.e., you get to have a mixture of being able to pick your own index funds or your own ETFs. And whilst Hargreaves Lansdown at this point in time will also allow you to buy shares, but not fractional shares like Trading 212 and free trade. So really big distinction here, guys. And the difference between being able to buy fractional shares is that if you wanted to go and buy Tesla, for example, at $600, you don't need to have the full $600 to get a share. You can put £100 into Tesla, buying a fraction of the share. With Hargreaves Lansdown, you cannot do that. Now, with these I call them hybrid because it is a mixture of the two. You select your own index fund, you select your own ETFs. You can, with Hargreaves Lansdown, buy your own individual stocks as well. So therefore, it's a hybrid. These guys are going to be relatively low cost, certainly lower cost than the first category that we talked about, where you are essentially taking on board a robo service or a robo provider, okay? So these guys will allow you to basically give you access to their ETFs and their funds. You select the one that you want based on your own decisions. They don't take you through a risk questionnaire necessarily. The onus is on you to understand what level of risk that you're willing to take. They simply just give you access to a ton of options. So they will be cheaper. Now, price-wise in this category, if you're looking at Vanguard, which is very, very popular, they're probably the lowest cost on the market right now. You can access ETFs with Vanguard and index funds starting from about 0.07%, ranging all the way up to 0.78%, which is one of their emerging markets managed funds, essentially index funds. So quite a big spread, and there's quite a lot in between. I've got a Vanguard series which I've done on here, which might be worthwhile you guys actually watching if you've not watched that already. But you've got a wide variety. One of the downsides with Vanguard is all of their options available to you will be Vanguard options. So you won't have BlackRock options or anything like that. They will all be Vanguard research and packaged ETFs and index funds available to you. If you're looking for a bit of variety, looking for maybe iShares, which is BlackRock, you're not going to get that with Vanguard. So it's worthwhile bearing in mind. But they are by far the cheapest when it comes to cost. And actually their performance isn't too bad either. So that's a Vanguard. Now let's talk about the likes of Hargreaves Lansdown, okay? And there are more than this, by the way. You can go and access BlackRock funds and stuff like that as well, directly with them. But I've just chosen Vanguard, Hargreaves Lansdown, and Fidelity as the three top ones that most people would generally think of. So with Hargreaves Lansdown, you're going to pay a fee specifically for your ISA account, and that is a 0.45% charge. Now, on top of that, if you are going to be buying individual shares, and with them, again, you can't buy fractions of a share or fractional shares. If you want Tesla, you need to pony up the full amount to buy Tesla shares. Same thing with Amazon or any company that you're looking to buy. So you need to have quite a bit of cash liquid in order to buy those shares. Now, if you do decide to do that, you're also going to have some share dealing charges, which is about £11.95. It's quite expensive, especially given the fact that you've got Trading 212 and Free Trade and even eToro now. eToro don't have an ISA account, which is why they're not included in this shortlist, as well as Stake and a few other providers that I can think of. But £11.95 is quite expensive. So that is going to be a big determining factor for many people using Hargreaves Lansdown for their ISAs, particularly if they want to be in control of what companies they buy. That fee and the fact that, well, you need to have the full $600 for Tesla, or even in the case of Amazon, $3,000+. It's a lot of money. So that's worthwhile bearing in mind with Hargreaves Lansdown. However, Hargreaves Lansdown have been around for a very, very long time. They're a big company, very reputable. They have some really, really good advantages in the fact that, unlike Vanguard, where you can only access Vanguard funds, you can access Vanguard funds, BlackRock funds, ETFs as well within Hargreaves Lansdown. They're kind of like an aggregator. So if you want access to a lot of options like index funds and ETFs without being restricted by provider, Hargreaves Lansdown is a pretty good bet for you to go down. So that's a good thing to bear in mind. The last one that I'm going to put in this category is Fidelity. Now with Fidelity, their cost ranges between 0.2 and 0.35%. You do have additional costs with Vanguard though, and it is worthwhile bearing in mind that these additional costs, you need to know about them up front. This is a little bit of a screen grab of what charges you might have with them as well. So you can see less than £7,500, 0.35% right there. And, if you have over $1 million, you're looking at, 0.2%. But you do have share dealing charges. Their share dealing charges, simple charge of £10 for each deal placed online. Phone traders are charged £30 for each deal. That is a lot of money. So a consideration to bear in mind. Yes, the fees in terms of the rates, and by the way, there may be additional charges on top of the 0.2 to 0.35% we've already mentioned here. So it's really important that you have a look through their website to make sure that you're happy with the charges. So just summarize this. If you're the kind of person that wants to just outsource this kind of stuff, then the DIY category, the ROBO category will be perfect for you. If you want control, you want complete autonomy over what stocks you're buying, over what ETFs and index funds you're selecting, then people like Trading 212 and Free Trade will be the best fit for you. The hybrid will kind of speak a little bit to people who want to have a little bit of control, but maybe want a mixture of being able to access index funds, but maybe a broader range of index funds and ETFs than the likes of Trading 212 and Free Trade can offer you at this point in time. So I hope that's helpful. The last thing that I do want to leave you with, guys, is a key date. Now, it's really important to understand and to remember, this current tax year is going to end on April the 5th, okay? That's in 20 days' time. You cannot just go and send money over to your Hargreaves Lansdowne or Trading 212 account on April the 5th and think it's all going to be okay. No, you need to give enough time. A lot of these providers will have lead times for when they receive your money and an actual trade is executed. And there's a debate to be had on whether they should do it on instruction, okay? But generally speaking, sometimes they do take time to execute your trade. So whatever you do, really what you want to bear in mind is you need to give yourself at least 3 working days to give them enough time to be able to execute your trade and make sure you've got money in your account. You need to think about how quickly you can send them money as well. Some places will allow you to send cash over to your investment account on the same day. Are you going to pay for that? You need to bear that in mind. So give yourself at least 3 working days. If you want to be really, really safe, you want to do this at least 5 working days beforehand. So the 1st of April, start transferring your money over to your provider of choice and give yourself enough time to get it in cash and get it invested and make sure that the trade is actually executed as well. Most of these providers have cash accounts, so it essentially means that as long as you have transferred money and it has landed into your cash account, you have utilized your tax allowance. And that's the most important thing here, guys. The important thing is not investing the money, is getting the money into your cash account so that you can tick off to say that you've used your allowance for this year. And by the way, if you haven't got the full £20,000 to invest, and I get this all the time, Pete, I've only got, £2,000, is it worth it? Yes, it is still worth it. If you don't use it, you will lose it. So it doesn't matter if it's £500, £1,000, £2,000, £10,000, make sure that you pay money into your ISA, get it into your cash account well in advance of April the 5th. Give yourself enough time. Don't give yourself too close of a deadline to work towards. So guys, I hope that you found this video useful. We've covered quite a lot there. Welcome any questions that you might have down below. I'm sure there will be questions. I'll happily answer them. We have got a live session on Sunday, so if you want to ask me questions there, feel free to rock up on Sunday at 9:30. But guys, as always, if you've not listened to the podcast this week, there it is right there. I appreciate every single one of you. Thank you so much. Have an amazing week. I will catch you later on.